Hey guys, welcome to another weekly update. This week we've seen more mortgage rate movements, with banks raising their short-term rates while dropping the longer terms. We've also had the release of an interesting paper by Inland Revenue, looking into the tax paid by our wealthiest families, as well as some big price movement in stocks here in New Zealand. If you haven't already, please make sure to subscribe to my channel down below to keep up to date with future updates. Starting with ANZ's Business Confidence survey, for a third month in a row, it has remained flat with a net negative outlook. Businesses expect wage and general cost pressure to continue at heightened levels, while ease of credit and profit expectations remain low. The risk of recession continues to play on the mind of New Zealand businesses, as the survey results show, and they don't appear to be changing. ANZ also released a surprising report on the property market, which suggests we might be nearing the bottom of the cycle. They've revised their house price expectations for a peak to trough fall from minus 22% to just 18%, meaning we could be just a 2% fall away from seeing the bottom of the housing market decline. The first factor driving this is net migration, which has surged in recent months to over 10,000 people alone in February. So while demand for housing is increasing, the residential construction activity is actually slowing due to fierce monetary policy, which may be a catalyst for prices to once again revise upwards. The second point was the Reserve Bank's announcement this week to loosen their loan-to-value restrictions, allowing banks to lend in greater volumes to those with smaller deposits, such as first-home buyers. Previously, banks had a 10% cap on the volume of lending to owner-occupiers with less than a 20% deposit. From the 1st of June, this will increase to 15%. And on the investors' side, there was a 5% cap on lending with less than a 40% deposit. This will change to 35% deposit going forwards. The third factor is that auction clearance rates in Auckland have increased throughout 2023, and the rate of deflation in Auckland house prices is starting to ease. And finally, the fourth factor is the declines in lower-term interest rates, which have now found themselves below 6% in the case of Westpac. In addition to the good news from the property market, our Prime Minister has also announced a no-frills budget and ruled out bringing in any new taxes. This comes after Inland Revenue released a report this week looking at the average taxation for 311 of New Zealand's richest individuals. It should come as no surprise that they created their wealth mainly through business and asset appreciation, which of course comes with little to no tax obligation here in New Zealand, as we don't have a capital gains tax. The report is very detailed, so if you're interested to dig deeper, it makes for a great read. Simply put, by redefining the definition of income, the Inland Revenue declared our wealthiest families pay on average 8.9% in tax, while our middle-income families pay over 20%. If we look back to 2019, the government backed down on introducing a capital gains tax due to the lack of a public mandate. It is hard to doubt this report was created to shift public sentiment on the matter, especially given we're in an election year. No matter what party is in charge, wealth and advantage has always been extended to those with businesses, stocks, and property. I don't see this changing, and what this report tells us is that the route to wealth in this country is through investing in assets, and coincidentally, it also attracts the least tax obligations. With the news out of the way, let's now jump into the local stock market. Over the past week, the market is up 0.67% for the week. 60 stocks rose while 92 fell, showing large cap stocks were the ones to benefit over the week. On the gaining side, we had New Talisman Gold Mines, Move Logistics have rebounded from their loss last week, Raycon, Hallenstein Glassons, and Paysource. On the losing side are Synlait, Vital, Mead Today, Metro Glass, and Wasteco. Synlait had a terrible week as they surprised the market with a massive drop in their earnings guidance, largely caused by A2 Milk, which downgraded its demand for Synlait-produced infant formula mix. Over in Australia, they had 74 stocks rise and 103 fall for the week. The ASX 200 index was down 0.42% for the week. If we look at the stocks that rose, this included Kogan, Blackmores, PointsBet, Nanosonics, and Calcium Group. On the losing side was Mesoblast, Mineral Resources, Bank of Queensland, Invocare, and Champion Iron. Over in the US, they have had a poor week, with all three indexes down over 1% for the week. The S&P was down over 2%, the Dow Jones 1.08%, and the Nasdaq down 2.95%. Looking at the S&P 500 by industry, only consumer discretionary stocks such as restaurants, retail, confectionery, and packaged goods were up. Pretty much everything else was down, especially banks, technology, and aerospace companies. In crypto, it has been a quiet week. Bitcoin is up just over 3%, while Ethereum, Ripple, and Cardano have moved up and down by around 1%. Looking at term deposits, the Chinese banks have moved their rates. Bank of China increased its 1 and 2 year rates by 10 points, while the 4 and 5 year rates fell by 10 and 20 points respectively. The best 1-year deposit remains with Rabobank and Heartland at 6%, while the 2-year now goes to Bank of China up at 5.5%. ICBC and China Construction Bank continue to have the best 3 to 5 year rates of 5.45%. Over on the mortgage side, there has been a bit more movement. Bank of China has increased its 1 and 2 year terms by 20 and 10 points, while their 3 to 5 year rates have dropped by 20, 30 and 40 points. BNZ has made some big moves, increasing the floating rate by 40 points, the 1 year by 20 and the 2 year by 4. They've also dropped their 3 to 5 year rates by 60, 40 and 30 points. China Construction Bank has increased their 1 year rate by 16 points and their 2 year by 10 points. The Cooperative Bank increased its 1 year rate by 10 points. And finally, Kiwi Bank has increased its floating rate by 50 points, 1 year by 16 points and 2 year by 10 points. They've also dropped their 3 to 5 year rates by 50 points across the board. Looking at the best rates in the market, there has been no change. China Construction Bank still has the lowest floating rate at 7.4%, while Heartland remains the cheapest for the 1 to 3 year terms. Westpac's sharp 5.99% rate remains the leader for the 4 and 5 year terms. So that rounds out another weekly update. If you enjoyed it and want to keep up to date on everything financial, please make sure to subscribe to my channel down below. If there's anything you'd like me to add, please let me know down below in the comments. Thanks for watching, and I look forward to catching you on the next one. Cheers.